but you're moving to a different city, a different state, and you've now decided to bank with a commercial bank. Well, down the street from your house is Bank A and Bank B, right across from each other. So you first go to Bank A, and they tell you that there is a monthly at least 1 to 4% on your money. So you go over to Bank B, and they tell you that you need to invest elsewhere, somewhere outside of the bank. And they give you somebody else to work with that can guarantee you 8 to 12% on your money. So you go back to Bank A and you're confused because most of your family members and friends, they bank with Bank A. It's the most popular bank. Everybody's bank. Unfortunately, 80 to 90% of people are banking with Bank A inside of their life insurance policy, which is whole life. 80 to 90% of people are banking with Bank A inside of their whole life policy. Now, when it comes to whole life, first of all, just like the name says, you pay for it until the day you die, for your whole life. And also, there is an investment attached to that policy as well, and you will earn no more than 4% on your money. It simply says this: insurance is probably the most misunderstood and least monitored area of personal finance. Studies show that more than 90% of Americans purchase and carry the wrong types and amounts of insurance coverage. In Chapter 16, the amount of term insurance you carry as your financial obligations lessen and you accumulate more assets. So in closing, I have these two illustrations behind me in order to drive my point on home. Now, if you have a whole life policy, most likely you'll pay for insurance from the time you find a job, get married, have children, all the way up until the time you die, paying for coverage your whole life. But we have a thing called decreasing responsibility. Now, in order to understand why you need a term policy, you first have to realize why you need insurance in the first place. And that's because if you have a young family, you have a lot of responsibility and no money.